Hello, everybody, and welcome to today's seminar. I think it's time to start. For those who are coming late, well, there's still some spots. Let's start with the introduction. We are very happy to be here today. This is the last seminar of this summer. Until September, there will be a short break. So we're happy to see everyone today and happy to see, well, the participants online as well. We're very grateful to Citi and for the generous sponsorship, and to Mosaic Start Data, who have been supporting this seminar since the start, and it has been very nice to be here again after COVID. Today's speaker is Stefan Zohren, who will be speaking about the momentum transponder and intelligent interpretable deep learning trading strategy. Our speaker is, well, both an academic and a quant. He is a principal quant in Mans Group Central Trading Division, where he is responsible for execution research across all derivatives traded by the company, including futures and FX. Much of his research leverages modern machine learning techniques and involves close collaboration with Man Group's investment engines. Stefan has worked with Man Group's Central Trading Division since 2018, first as an external scientific advisor and then transitioning to his current role in early 2020. He has previously worked in quantitative strategies at 2 high-frequency trading firms. He is also an associate professor and faculty member of the Department of Engineering Science at University of Oxford, as well as a research fellow at the Oxford Mann Institute, where he previously served as a deputy director. His academic research is focused on applied machine learning in finance, including deep learning for time series modeling, reinforcement learning, network, and NLP approaches. Stefan has published more than 80 scholarly articles, most recently co-authored a paper quantifying long-term market impact, which has won the best article in 2023, Bernstein, Fapozzi, Jacobs, Levy Awards. Stefan, we're very happy to have you today here. The floor is yours, and thank you very much.
Thank you. Get the clicker here. So yes, thank you very much, and thanks for the invitation. It's great to be here and be speaking about the momentum transformer. Actually, I'll be speaking about 3 papers, a sequence of 3 papers. So I'll try to squeeze it into our 45 minutes. And actually, the last paper is a momentum transformer. And I'm also very happy that one of the co-authors, Kieran, is actually sitting here. He's been doing a lot of the hard work, actually, which went into those results. So I'm really glad that that he's here. So this is more of a kind of engineering science talk, so it's not very heavy on the mathematical side, but I think it's actually quite interesting and quite relevant to practitioners. So brief outline, I guess many people are probably familiar, but just I will very briefly just give a quick overview of what is classical time series momentum, contrast it with cross-sectional momentum, and see how we could potentially improve things using more machine learning models. Then I will mention some of our earlier works from around 2019, which is deep momentum networks. Then a subsequent paper where we introduce change points and make the model more regime aware, which helped quite a lot, as we will see. And then the most recent paper, which is the momentum transformer, where we basically went a step further and said, well, these are kind of 2 models mixed together. Can we not have one smarter model which does it all at once? And this is a momentum transformer. And we will actually see that despite it being deep learning, despite using a lot of the kind of fancy acronyms like the transformer, which is obviously the T from things like ChatGPT, it does actually provide us with some interesting things such as interpretability and giving us a way of actually poking the model and seeing what it does. So it's not let me get just started with the classical time series strategies. I think very briefly, I think most people now, when I speak about time series momentum, is the idea of kind of or trend following, which is something a lot of those commodity trading advisors like Man Group, for example, have been involved in for a long time. And the idea is if some stock is kind of outperforming, it's most likely to continue to outperform. And there's also a whole literature in finance, people from behavioral economics trying to explain how those trends seem to persist and don't seem to be kind of upped away by sufficient Marquis hypothesis. And some of the earlier papers is, for example, no, I'll come to this later, just to say that we should contrast it to the cross-sectional momentum, which sometimes people mess up a little bit. So time series momentum is effectively univariate. I observe the trend in one instrument and I follow that in this instrument. It's not the same as cross-sectional momentum, where I have a basket of securities, like in a long-short portfolio, and I kind of go long the kind of top decile and short the bottom decile. That's cross-sectional momentum, and I'm not be talking about this today. I'm just speaking about time series momentum. So when we have a strategy, what we usually do, we kind of first look for a trend. So we want to have an estimate. Is the instrument trending? And then given this trend estimate, we try to trade into a position. And usually this is done in two steps. There's a trend estimation, which sometimes could be a forecasting step, where I maybe try to predict next year's future return using a regression. And then I try to size positions accordingly. And we will see how in these more modern machine learning techniques, we are also doing things slightly different. So what has also been observed and what is done a lot in practice, that people use this thing called volatility targeting, where effectively if I trade a certain signal, I'm actually targeting it with a given volatility, which is usually given by the kind of past performance of that signal, or in this case can also be given by the price of the instrument. And that you can view it as well as a very simple form of portfolio construction. It's effectively just having a diagonal covariance matrix. It's something like a max diff portfolio. It's actually, some people say it might be unrealistic. I might want to do some more sophisticated portfolio construction, but actually it's what many people do in practice in future markets, because in future markets you have more kind of independent opportunities for momentum, as opposed to, say, if you work in equities markets. So if you have our whole portfolio, it's effectively just an equal weighting, the return of the portfolio of the individual returns, which are just the return of each asset, the position I take, which is X, which is the kind of trading signal, and then this position, this volatility targeting, where I have a target volatility, which could be, say, 15%, and then it's normalized by a trailing estimate of the actual volatility. So if this is lower, it will kind of upsize it. If it's larger, it will downsize it. And that usually helps also in crisis events. And then those position sizing, so in this kind of classical momentum papers like Moskowitz, you just say, this is a very classical paper, but they just say, I have a very simple momentum strategy where I say, I just take the sign of the last year's return as my signal. If the instrument went up last year, it's trending upwards, I buy. If it went down, I sell. And they show that actually, if you go back over a long period, like 70 years or so, that it actually kind of outperformed long only. But this is obviously a very simple signal. And then in practice, people use other signals. But you can think about this framework where I have this framework, and all I want to do is maybe replace this with something slightly smarter. In practice, often people use those MACD signals, which are just those crossover. It's just the difference between two EWMAs of a longer and shorter frequency, which gives you some trend estimate. You might have seen those around, and that's actually what many CTA funds still use in kind of production systems. So now we come to those momentum networks. So what we did in this earlier paper, and I don't want to go through the whole paper, I just want to give you a very quick summary. I won't talk about data and all these things and performance, because I introduced those when we came to the main paper I want to speak about. But just to give some context, what we did there in this momentum paper, which is some work with Brian Lim and Steve Roberts, is we wanted to think about a data-driven way of building those models. And in particular, we wanted to get rid of this forecasting step. If you saw earlier, we have this thing where effectively we try to forecast a trend, which gives out X, and then we want to turn this into a position, and it's not clear how am I going to do that? For example, a very large forecast is most likely supported by very little data. So maybe I don't trust it that much. So I don't necessarily want to follow my forecast linearly. And obviously, if I forecast, I must have some form of loss function, say least square or something like this. Could also be Huber loss if I'm concerned about outlines, but I have to define a loss function. And there's no guarantee that, say, Huber loss will give me the best Sharpe ratio. So what we thought at the time, what if we had a network which basically takes certain market variables like past returns or MACD indicators as input, and then the output of the network is effectively this squashing function, is a tan H, which gives us X. It's a kind of continuous variable between plus minus 1, which is the position I want to take, which is then volatility targeted, put into the portfolio, and then the network automatically backpropagates and optimizes for portfolio Sharpe. So the basic idea is, let's kind of take out this forecasting step in the middle and straight optimize for portfolio Sharpe. And it might actually be that I have better possibility to actually train the model rather than trying to do the forecasting task for given instruments, because the loss function is also averaged over the entire portfolio. So this is the basic idea behind those deep momentum networks, which is this earlier paper. And at the time, we tried different architectures, and we showed that it actually worked quite well with a LSTM network. But you could basically put in anything here. So we had those inputs, which would be past returns and some MACD signals. And then we will put them into our LSTM model. Then they get turned into position. Then this position is volatility targeted. We evaluate the portfolio Sharpe, and then we optimize for maximum Sharpe ratio directly when training this model. So this was the original idea of the deep momentum paper, and it actually worked quite well. We got very nice Sharpe ratios, but actually when we looked at the transaction cost, we saw that we do have quite high degradation. If we increase the transaction cost, performance goes down very quickly. And when we analyze which features it is actually using, we saw that it loads on the kind of classical trend following signals like MACD as inputs, but it also loaded a lot on kind of short-term daily returns. It actually, what it did intuitively, this is just me drawing my intuitive view of what it did, it follows long-term trends, but it was also just trading short reversion, and it does a blend of it, which was fine. It kind of outperformed by learning to follow the trend and at the same time trading a little bit of reversions, but it's not ideal, because if you look at it, you can see, well, here the market is nicely trending. Here, I don't want to follow the noise. It just causes additional transaction costs. Whereas here, the market is a little bit undecided. Here, I don't really want to trust the trend because it's most likely going to be wrong. I would just like to follow the reversion. So we wanted to have something, some upgrade to the model, which makes it more adaptive to those regime changes. And that is exactly where this idea with change point detection came in. So the basic idea was, if you could somehow find these divisions here where we say, this is a kind of more reverting regime, this is a more trending regime, that would be ideal. And obviously it's a very good thing to do. And some might say, okay, this is just, if you could do that perfectly, that would be the holy grail. Obviously we can't do that perfectly, but we gave it a try, and we looked into, rather than doing it by hand, some people like to use something like hidden Markov models and maybe train different models for different regimes. But we said, what if we just have some kind of notion of change point, and we just give it as an additional input to the model? Hopefully it can learn by itself something like, if there was a strong change point very recently, maybe I should ignore all those long-term trend signals because they're probably wrong anyhow now, and should focus more on the shorter signals. Can the model actually learn something like this? So we thought this is basically what we set out to do, and we looked into some past literature. So there's some work by, for example, Cam Harvey, which also thought about those change points, and they called it momentum turning points. So trying to see when can we actually determine those momentum turning points. And there were some classical strategies, which are effectively just some blends of kind of short and long momentum, which they try to use to kind of exploit this momentum turning points. That are some classical papers from the finance literature. And we thought, well, maybe we can improve them using some more novel machine learning techniques. And so we went to change point detection, and we focused on not deep learning right now, but some of the best change point detection modules we knew also from work in our group are using GPs, which are kind of Bayesian models. And the basic idea is that we have some return data, so the inputs are also daily returns, and we're trying to fit a GP to this model. And similar, like when you train a regression tree, you can effectively say, what if I had two kernels with different variances? And I will try, rather than fitting one kernel, I will try to fit two kernels, and I'm looking for the best split. Where shall I switch from one kernel to the other? And this will basically give me a change point location as well as a severity, because if I think about without change point, I have one loss for my GP, and then with change point, I hope I have a lower loss. It's more flexible, so I have a lower loss. And then how big this decrease is will tell me how severe the change point is. If there isn't really any change point at all, you won't see much of a reduction. But if there is, you will see a reduction there. So this is what we did. And rather than using those two kernels, so this is basically, I tried to fit one kernel, which is different on both sides, but that's actually computationally not so well suited. It's much better to work with something like this, which is effectively just a sigmoid function. You basically tune out one kernel and then you tune on this other kernel, but rather it being abrupt, it's continuously doing that, and that just makes it much easier to train this. So we did this, and we did use some return kernels for the change point model, and we compute those quantities. So this one here is the kind of reduction in loss. This is the severity of the change point, nicely rescaled to between 0 and 1. So if it's 1, if it's strong change point, if not, it's not so strong change point. And then I also have the location of the change point rescaled by the look-back window. One thing which is quite important here, we always have a given look-back window. That's the kind of hyperparameter. Say every day we look back a given number of days, say 60 days, and we try to find a change point in the last 60 days. And the model always finds one, and it might not be a good one. If it's not a good one, we will just get a very low reduction in noise. This is basically how it works, and it's much easier to explain in a picture here. So this is 2020. This is March 2020. You see kind of how the kind of volatility goes up, and obviously this is when you fit one kernel for the entire data. And if you allow yourself to fit two kernels, you get a very nice change point. What is very important about this change point, because we're trying to actually use it in this kind of trading situation, it has to be online, which is quite important. So every day I'm looking back 60 days and I'm trying to find this change point and the severity. And it doesn't mean if here is a change point that I will see it that day. I might have to go a couple of days further for my model to pick it up. And this is also how the reality works. And this is how sometimes things can go wrong if you might use other models. So this is a genuine online model, and it might also change its mind. So maybe it thought that there was a change point somewhere in February in 2020, but once we went through March and we were just towards the end of the March, it realized that there was a strong change point in March. It can then change its mind and revise it once it has seen more data. That's quite important that the whole change point detection is actually online.
Question, I don't know. Is it audible? Okay. So how do you choose the kernels, the two kernels that you are testing for?
Yes, we just kind of use, I have it somewhere here, those return kernels, because there's a lot of literature which says those are good kernels for fitting return data, which has slightly fatter tails. This is basically the choice, and you just have the kernel variance, and those is then fitted differently on both sides of the kernel. This is just a very standard procedure. You have the return series.
Do you have to predefine the what variances you assume, or
no? This is fitted. Yes, but the form, the functional form of the kernel is specified, and you could potentially try to do some more hyperoptimal parameter optimization, trying different types of kernels. We stuck with this one, which we know is kind of known to work quite well for the return data. Yes. So what we then did, so we kind of put it now as an input to the deep momentum network. So we have the same inputs as before. I didn't tell you earlier on exactly what were the original inputs, but the original inputs were volatility rescaled past returns of like 1 day, 21 days, 63, and so on, as well as some MACD signals. They always have 2, 8 days, 24 days, 16, 28, and so on. So those were the original inputs to the deep momentum network I briefly mentioned earlier. And now on top of it, we also put in this change point information. So each day I have a change point location and change point severity. And we tried different things. We tried to put in change points for multiple lookbacks, as well as parameter optimizing for the best lookback window. Generally, we found that those models can't really take a lot advantage of multiple lookbacks. The model is not complex enough to utilize this information. And then to the data, so all this, the previous paper as well, it's trained using futures data. So this is what is quite often used. So a lot of the CTAs which trade those momentum strategies in real life, they all trade futures, and a lot of them also have daily strategies. So we have daily futures data from 1990 to 2020, and it includes commodity futures, FX future, fixed income, equity index future. It's a whole bunch of futures there, 50 contracts we have. And then what we do is we train it using 5 years of data, and then we test it on the next 5 years. Then we go back and we retrain for the last 10 years, and we test it for the next 5 years, and so on. This is the way of the rolling trading procedure. And within the training set, we set aside 10% for cross-validation, which in this 5-year training, we have 10% to find the best hyperparameters of the model. And yes, this is how it's done. And here's just some example of how this specific model looks like in terms of performance. And it's nice to maybe to focus on this figure here. It's on the log returns, and it's also rescaled to have equal volatility. You can see it's nice to look at this by eye, but it's just also higher P&L means higher Sharpe ratio because they all have the same volatility. It's just a nice way of looking at it. And what I like about this picture is kind of nice if you just focus on the top lines here. So you have the LSTM plus change point detection, and then here we have MACD, and those are some of the benchmarks from Cam Harvey's paper. And what's quite nice to see is actually kind of, if you look like up to the onset of electronic trading, it seemed to be all quite similar, whether you did MACD or whether you would have done any of the advanced machine learning techniques. You didn't really had any benefits there. But then suddenly the original model, the orange one is the original deep momentum network without change points, starts to outperform all the way up to around 2014. And then you see it stays about flat. And if you know some people in the CTA space, they have been worrying quite a lot about this because momentum has been not so well performing after 2014. And many people went and said, oh, let's look at some other asset classes. Maybe you have to go to something less explored and try to see whether momentum works somewhere else. But what it seems like is that if you look at the one with change point detection, it actually seems to continue to perform well even after 2014, which can just mean that maybe markets became a bit faster or more adaptive. So it's much more important to be able to be reactive and switching around between different regimes than it was before. This is just a table here, so you can look at the Sharpe ratios. I will come to transaction cost in a little bit. So this is just before transaction cost. We will get to it later, but you can just see that if you look at some performances, for example, the original deep momentum network, this is the type of Sharpe ratio you have here, 1.6. And then if you use change point detection, you can go a little bit higher above 2, basically. This is just the kind of essence. And it's nice, you can actually have a little look of what it does and where the problems are. So here's just an example. I will just go through the right-hand side in the interest of time. This is British pound during Brexit vote, basically. And then you see it's kind of going down quite a lot, and then it recovers a little bit, and then it goes down. If you have like a traditional, that's not even MACD, traditional deep momentum network, it just kind of goes, this position here just goes short, thinks there's a downward trend, and it just kind of follows the trend. It goes a little bit up, but too late. It's because it has all this volatility adjusting with a look back. It's basically, once it realizes the market has been dropped and it's going up, the market just already went the other way around, which is something many of the real CTAs got caught on the wrong foot during COVID, because it went down so quickly and back up again. Once the market was at the bottom, the model was updating their slow momentum update and then dialing down the position after they had lost all the money, and then suddenly the market was going up and they missed out on the rebound. Basically, something similar you can see here as well. The traditional signals, it follows the trend, but then obviously the trend reverts and it loses money, and now it's going back down again, but now it's actually traded out of the position and continues low. So that's kind of actually what you see even in practice in some of these strategies. So you can see that the model with change point detection avoids this flip by effectively being able to just be more adaptive and going more on reversion during this period before it detects a clearer trend. Now we come to the real part of the talk, the momentum transformer, which is something which is advertised in the title. And the basic idea was, so we have these two papers. So one is the momentum, deep momentum network, where we have this kind of end-to-end architectures. We have some features there, past returns, MACD signals. And then we said, okay, it learns reversion and momentum blended. Ideally, we would like to be able to learn how to focus more on momentum and reversion. Let's add this change point detection. But the change point detection just uses past day returns as inputs as well. And the model has seen those past returns. And if it's a model with a memory, it could have kept the memory of those past returns. So there's no reason why a more complex model without change point couldn't learn that as well. It does have the same information content. It's just that some of these LSTM models, if you have sometimes maybe heard, they are not very good at learning long-term dependencies, because they kind of, to avoid this vanishing gradient, they have to forget always. And then they keep on forgetting. And then if something, especially if something is periodic, where it was relevant a week ago, but it was not relevant yesterday, then something like an LSTM will forget it, and then it doesn't know it anymore. So then we thought, well, models which can actually deal with those kind of behaviors are attention-based models. So attention is a very intuitive name. It's just being able to attend to previous past time steps. So rather than having an LSTM, I want to be able to attend to any return over the last several months. And then I can learn that I might want to attend to specific points there. So that was kind of the premise. What if we took some transformer-based models? Can we actually get rid of this change point detection and get similar performance, or maybe even better? And yes, that's what we set out to do. So transformers, as well known, are part of a lot of the large language models. ChatGPT is a general purpose transformer. And there have been some specific adaptation for time series models. In particular, there's the Informer, and there's also the TFT, which is one of the papers written by one of our graduate students while he worked some time at Google, which is one of the transformer adaptations for time series. It's quite interesting. So I don't want to revise everything on the transformer, but the basic idea is that transformers try to deal with the computational bottleneck of attention by getting rid of the recurrent structure by effectively having a position encoding. So rather than putting in things in sequence, I keep the value and the position, and then I can just train it without preserving the sequence. So effectively, transformers were an effort to get rid of the recurrent structure. But what they actually did here, in some of this work, they showed that if you look at time series, it's actually quite good to bring the recurrent part back into the transformer encoder, and it actually helps quite a lot with performance there. And I would speak a little bit more about this architecture. So you have this kind of traditional transformer, and there are different versions, decoder only, convolutional, but I think the most interesting are the informer, and this is a temporal fusion transformer, which is this model which came out of our group. It has this interesting feature. So first of all, it brings back the kind of recurrent nature in the encoder, and it also has something which is called shared multi-headed attention. So you, rather than having different attention models for different features, you have one shared multi-headed attention, which means you can actually interpret the attention rates. Now, attention rates for a given day back are shared. So if there's a lot of attention on some values from a week ago, I can actually then interpret that the model is kind of focusing on this, and this is something which is relevant to my prediction, and I can actually get an understanding of what the model does. And this is the architecture. It looks similar like before. This whole blob is now where the simple small one was before. This is just a standard kind of transformer-based model. The difference in the TFT that it still has this LSTM encoder. And what is quite interesting also, this is nothing we introduced, the standard of transformers. You have those errors which pass by, those kind of skip connections. Sometimes the model can just decide, I don't need all this stuff, I just pass by it. That actually helps quite a lot with regularization and overfitting, because we see we actually have quite some number of parameters, and there are not so many data points in our data. Sometimes people ask, how does it work? I think the skip connection helps quite a lot in actually being able to regularize those models. So this is kind of the standard transformer, but basically what we did, we just replaced the LSTM with a more complex model here. And here you can see some performance results. So I mean, you can focus on the Sharpe ratio if you like. So we focused also on the performance, especially during this last period, 2015 to 2020, where we knew the other models were performing quite badly. And we can see that, for example, the LSTM, which before was like 1.5, 1.7, now is only 0.8 here. It does perform quite poorly during this period. And then those models here, which do have transformer, perform quite well. What we did, because we computed this change point detection, we also added the change point detection. See, can the transformer actually make more sense of it? Yes, it can, and you get even better performance. If you just want to squeeze out the performance, you can add everything you have. But what I really like, I would rather like you to focus on the line before, that even the transformer without any change points does perform nearly as good. So the transformer seems to be able to learn the benefit of the change points without actually having them. Adding the change point makes it a little bit better, but not dramatically better. And you can see also the performance, especially during the COVID crisis, where one of the classical models perform very, very poorly. The models are just too slow to adapt, and they have this phenomenon which I mentioned earlier, where the market just went down. They just lost money, and then by the time it was at the bottom, they realized and traded out, and then the market rebounded and they missed the rebound. That's what happened to those models, and it also happened to many people in real life. And it's nice to see that those models actually avoided, and have some nice figures where you can see how this was done. So here's the performance, and you see, as I mentioned, so this is long only. This is the LSTM model. So you see it performs not so well over the last period. And then here you have the transformer-based architectures, which are the ones which set themselves aside, the informer, and then the TFT-based models. You see the best one is the one where we have the TFT and change point detection on top of it. Now the model can also make sense of having change points with multiple lookbacks, where the previous model couldn't make sense out. So you can squeeze some more performance out. But I rather like to ignore it and focus on this violet line and say, or the purple line, and say, actually, the purple line is nearly as good, and it just does not use any change point whatsoever. So the model somehow seems to be able to learn this behavior. And you can see that especially during COVID, this is what I mentioned here. The model loses, it realizes, trades out, and then now it misses the rebound. That happened to many people. And then even some of the kind of smarter models have this slight dip, but then you see many of the transformer-based models again are here on top and kind of being able to switch around very quickly when the market turns against them, and then also be able to reposition themselves very quickly again. I'll show some nice pictures where you can see actually how the model does it. And also I want to give you some nice interpretation how the model does get to similar results like we had with the change point detection, but without the change point detection. Can we actually see how it is able to learn something similar by itself? And it's quite nice to look at those attention weights. So those are the attention weights, and they help us to give some interpretability. So the attention weight is the model at a given moment in time. So the green one is we are at this moment in time, somewhere in July in 2020, and the model is looking back all the days in the past, and you can see how much attention is to this model at this moment in time is paying to the past. And you can see how it goes up here. Now, if I go this point here, somewhere in May, the model looks back to the past and it pays some attention to its recent past, but again, it pays attention to here. This model here also pays attention. Everyone is paying attention to this cliff there, which is where the change point was. So we can kind of intuitively see here that how is the model getting away without change point detection? It has these spikes in attention weights, and even if it moves forwards, it keeps on attending to this past event, and this spike in attention weight effectively provides it like some form of change point, which it will remember. And this is kind of at least how we intuitively can think about how the model gets away without the change point, getting similar performance results by just learning it directly from the return data. And here's some more examples. What is quite nice to see also, again, similar pictures here. It just gets a bit messy. So you can look at the, rather than looking at the attention, you can look at the mean and standard rolling mean and rolling standard deviation, which is shown here. And you can see if you look at, like, for example, the green one and the orange one are markets which are somewhat trending upwards. And you see that the model has a kind of quite similar attention pattern. Whereas there's a market that's kind of trending downwards, the blue one, you can see that the attention pattern is actually quite opposed to each other. So the model is attending differently to different moments. We can see moments in time maybe of similar market states are attending similarly to the past, whereas like moments where we have maybe quite opposing market state are attending opposingly. So it's kind of interesting because this is something you can see through this interpretability. This is why I think those transformer models, while they are very complex, are quite interesting, because we have all these methods of being able to interpret and actually understanding what the model is doing and is it actually learning something sensible. And I can also look at variable importance. You can also from the model see actually how much importance it is giving to any of those input variables. And here you can see that, so those are the different input variables, a kind of daily type, monthly, quarterly, MACD of different frequencies. And what you can actually see here is that those red one particular here, those are the, or the other way around, those are the slower signals here, and these are the faster signals. So here it is focusing more on slower signals, and once it goes through this moment here where the market is undecided, it dials down on the slower signals and dials up on the faster signals. So you see the model is getting more adaptive during this period of time and not following any of the long-term trends, and it's just focusing on what is immediately in the past. If the market is undecided, I don't look back very fast. Whereas if I think the market is trending, I'm happy to look back 3 months into the past to get a stable momentum estimate. And this is what the model is effectively learning without any of this being kind of hand-coded into the model. So this was what was quite exciting for us. And also to see that, generally speaking, whenever we do something fancy machine learning, it usually increases transaction costs quite a lot. And then it becomes very difficult to implement those models in practice. And it becomes a matter where you really need very, very good execution to be able to kind of run any of these sophisticated machine learning models in practice. And usually the more machine learning, the more turnover and transaction costs. This is also the case for our original momentum network. If you go from MACD to the original momentum network, turnover goes up quite a lot. And if I'm not very good in controlling the transaction costs, any gain is very quickly lost. What was quite nice is that once you go to the transformer-based models, they are actually getting better as well, even with more transaction costs. Just because it is smarter and more adaptive, if there's a clear trend, it just follows it. It doesn't do like always doing reversion and always doing trend at the same time. If there's a clear trend, it doesn't do any reversion. It doesn't lose out on following some noise. But then if there is a kind of lack of trend, it will just follow the trend. So now actually we see that even with transaction costs, the performance holds on quite longer. So here's just a table. Modeling transaction costs is a tricky business. So I do that for part of my living. So, and it obviously depends on the size you're trading. And some of the paper you mentioned deals, which we won the prize for, this with long-term impact, which is actually when today's trading affects tomorrow or the week after. And that happens actually quite a lot in momentum, because this momentum signals are quite highly autocorrelated. So most likely if I buy today, I buy tomorrow as well. And I'm probably pushing the price, and I don't even see that because I'm marking to them open tomorrow, and I don't even realize that I had actually pushed it and the price is dirty. So that's a quite difficult bit to model, and it depends on each kind of practical kind of implementation of and asset allocation of what the actual transaction costs are. But what we can do to a first approximation is just look, if we have a proportional model, we say we pay a transaction cost of a certain proportion and basis point, what would be the performance afterwards? And here we go all the way to 3 basis points. Just for those of you, many people are in equities markets, or in equities markets, you might expect some 10 basis points or so, give or take, transaction costs. For future markets, you speak like 1.5 or something like this is what you can get in practice. So those are reasonable transaction costs here. And you can see that the transformer-based models actually perform quite well, also up to larger levels of transaction cost here, 1.5, you get quite decent Sharpe ratios still. We also looked at individual sectors like commodities, equity index, and so on. And rather than we just present the mean here, rather than the portfolio, because there are obviously different numbers of instruments in each of the groups, so it would be unfair to compare the overall sector Sharpe ratio. So this is just the mean per instrument Sharpe ratio for all of those. And we see that generally it works quite good for commodities, which is one of the insights here. And yeah, people are leaving, so it's probably good to get to the conclusion. So what I try to do here is kind of walk you a little bit through a series of papers, which is our first paper, which is the Momentum Network, which came out in 2019, which introduces this idea of end-to-end optimization. I think this is actually the first one to consider the end-to-end training, where we kind of sidestep the individual prediction task and then the sizing of the positions and go straight to the portfolio Sharpe and optimize over that in the inner optimization. Many practitioners might do that in the outer optimization, but not in the inner optimization. And then from there, we saw that this model actually works quite well, but it suffers quite a lot from high turnover. Transaction costs are quite high because it's always blending a little bit of reversion on top of the momentum. That's not very smart. Let's try to make it smart and more adaptive by introducing this change point detection, which was this next paper, where we then said, okay, let's train this online change point detection models and just add it as an additional input can the model learn those? And those are kind of genuine nonlinear effects, something like if recent change point, if there's recent change point which is large, then focus only on short signal. If you write it out in equation, you see that's a nonlinear interaction actually. So you need some form of nonlinear model, but you expect it should somehow be able to learn it if it isn't terribly overfitting. And we actually saw that it can pick up those to take advantage of this change point information. We also saw some nice plots how we can see that what it does is actually quite reasonable if you investigate it in some cases. And then the next step was to say, well, if the change point detection as an additional input, which is completely separately trained from the main model, works well and it uses the same inputs, a joint model, which is smarter, should be able to kind of get along without the change point detection and learn it by itself, and then also can learn it directly without having two separate models trained. And that's exactly what we do in the momentum transformer. But we realize that to be able to deal with these change points, which can potentially be further in the past, we need something like attention. And this is why it didn't work previously, because the LSTM is just not good in picking up this long-term dependencies and then keeping track and attending to the change point where the regime change was. It just can't do that easily, but it seems like from the results and from the interpretation we have that the momentum transformer is actually able to do that. So those were the three papers here, which is the momentum transformer, the change point, the deep momentum networks, change point detection, and the momentum transformer, the last two with Kieran, who's also here. And we also have some interesting extensions of this paper, which I didn't present here today. We have some extensions in cross-sectional strategies where we try to use ranking algorithms similar to the ones like you use in information retrieval to try to better rank the assets and then also maybe re-rank them. So we have some papers on that. And then we have some work in progress actually also with Kieran on using multitask learning. What actually, if I have some new data set, can I maybe learn some behavior on some data and then very quickly transfer to a new data set? That's obviously quite interesting and quite important. Think about, say, you have a lot of FX data and a little bit of crypto data. Can you maybe learn something in this case, or maybe even other more kind of traditional asset classes? So that's something where we have done some research also in, which is coming out in the near future. I would have liked to include it in the talk, but it's not yet ready. So yeah, this is all. Thank you very much.
Thank you very much, Stefan. We have time for questions. The timing is really perfect. So we have time for some questions. And I will, maybe I will start with the first question and then we pass on the microphone. Does it depend on what sort of data you're looking at, how many attention heads you typically get? Because we saw some examples. What are likely numbers of attention heads that you...
What do you mean in terms of data? You mean different asset classes?
Yeah, does it depend on the asset class? Does it depend on the time frame that you're looking at, etc.? So what would be the typical number of...
Yeah, there's generally some dependence on time frame. We have seen that, obviously, I've just told you that you can generally blend short-term reversion with long-term momentum. So there is reversion is maybe more common in the time series, maybe over days. Momentum is then longer at weeks or months. And then obviously you could also go intraday, and then you have again changes where maybe you have trending over several hours and maybe reversion at shorter frames. So depending on which time frame you look at, you're looking at different of those things. Here we focus on the kind of time horizons which are typical to those MACDs. So the kind of very classical MACD, very classical CTA strategies which have been around since the 80s. They usually look at this kind of 3 months to 6 months trend which they trade, and we try to kind of start from there and say, how can we actually make this better? Can we make this specific model smarter? And this is why we also put the MACD signals as inputs rather than trying to learn everything. And we have some extension where we actually say, well, the MACDs are again just computed from the return. Why don't we give it just the returns and let the model figure it all out? This can be done as well. But I think to get some traction, we thought, let's just start simple, not deviate so much from what people in practice are doing. Let's just do access MACDs and some additional return data and see, can we actually learn something better? So yes, we started with those frequencies because that's what kind of is most commonly used in practice. That's why we also have this look back of roughly 2 to 3 months. It's quite aligned with the type of, we don't have anything much longer anyhow, so you don't really care what was beyond this, because it's the input that has to choose from are more or less up to this frequency. So yeah, this is with regard to the length.
I have a quick question. Have you tried pre-training your transformers? So like BERT, they pre-trained it on certain generic language tasks. Have you tried pre-training it on some generic time series tasks and then applying it to the specific problem?
No, this is obviously quite different here to how things are done in NLP. So those transformer models are specific to time series, and it's also differently trained. For example, if you look at some of the language models, the masking might allow you to see the future of this. You black out a word and you can also see the future and the past. You can't do that in time series. These time series models are very specifically trained. And obviously, if you pre-train it on what? And which date range? Because if you have the model up to 2019, whether you pre-train it on some data from the future, then we would be looking into the future. So that you have to be very careful. Things are slightly different. So the pre-training doesn't work like this. When we do this kind of multitask learning, we think about training something on some instrument and then being able to transfer this learning to other instruments. But you have to be very important with the point in time. Just little advertisement, because we have some work also on the NLP space. A lot of people get excited about ChatGPT and all those things, but it's obviously completely useless for kind of asset pricing in a way, because you cannot do any backtest with it because it just has all the information up to now in it. If I ask ChatGPT to help me with some volatility forecasting, if I tell it end of 2019, it with some news about lockdown in China, it will get all nervous because it has seen what lockdowns cause us, but it only seen it because it has seen the 2020 text data. We would have not known this. So, I mean, one of the things we are actually working on in some of the more NLP work is actually building point-in-time language models, and which have financial data like filings and news up to this, but also have a core text understanding up to this moment in time. So we have like Wikipedia snapshots every year to be able to train those models. So we have a whole research section on this, but it's actually quite tricky to deal with this pre-training without taking data from the future there. So that makes our life quite hard. In this natural language processing models, you don't care about taking all the data available and you can deal with those things. Here we would have to be very careful that the pre-trained model is only masked up to this moment in time, and that will be just a mess and quite complicated then.
Thank you a lot for your presentation. I have 2 questions. First is, it seems that the most of the attention in your are placed on the for the period with the change points. So that kind of change points may be generated by some market events, and without any analysis of causality, how can we trust this kind of events can have long-term effect in the future period? This is the first question. And the second is about the change point detection. If we use the real data, there are a lot of jumps in the price and returns. So even you use the maternal kernel for Gaussian process to fit that, it cannot fit the jumps. And when we try the change point detection, there are some like fake change points in the price and return data. For example, some abnormal returns only lasting for like 1 day or 2 days, and that will result in a lot of some fake change point detection and makes the results not really reliable. How can you get to avoid of such problems?
Yeah, maybe let me start with the second question. So one thing which is important, so we always look back, given look back window, and we only allow for one change point in between. So it's not like I mean, you might have issues when you allow yourself many different change points, or each time if it is above a certain threshold, you label it as change point. This is not what we do. We always look back and we just look for one change point in the data. So if there are many kings, it will only find the most dominant one, and this is the one we focus on. And then we have this loss function here. So effect here, this is a very clear change point. If it's less clear, the reduction will be not very high, and then this change point severity will be very low. And we give this change point severity as an additional input. And this is again something, if you do something handcrafting, you might say, I now introduce a threshold, and whenever severity is above a half, then I call it a change point. If not, not. We just said, no, let the model figure it out by itself. It gets the severity, the location, and then it can just do it. And ideally, it should learn if there's a severe change point very recently, then I focused on the more recent past. If there's no severe change point, so there can be a change point, but it's not very severe, then I just keep on focusing on the longer trends. Or if the change point is very far away, then I keep on focusing on the longer trends. But we kind of avoid some of these issues first because we only allow ourselves one change point to be in the past. So there will only be one. So if there's some noise, it will just pick up the most severe one. And then we give the severity as well as an input. So the model can just learn to ignore the ones which it deems are non-robust. And after all, a non-robust change point will give you less a good Sharpe ratio. So it should be able to learn this, and that's what it does, basically.
Thank you.
And
the first question is about the causality.
Yes, yeah. So the first question about the causality. So, I mean, in principle, there is obviously, I mean, there's clear temporal information. This change point detection is online, so you're never ever looking into the future there, which I think is what you might be concerned about. But then otherwise, we're not trying to distinguish what is kind of causing and what is cause or effect. What is important that the change point improves the performance, whether it's actually the change point which is causing it or something else which has caused the change point. That's kind of not so relevant to us at this stage, which obviously there can be some correlation. Maybe I think your argument might be, so first of all, we have a clear causation in the training, so we're not looking anywhere in the future, but then you might say we're attending to this change point, but maybe actually this is caused by something else, and maybe we should focus more on the original cause. But after all, it is just a correlation which matters to us.
Thank you so much. Thank you.
Hi, so I do have a question about the interpretability of the attention weights. So could you go to the slide where you show the intuition behind the attention weights?
It's fine.
Yeah, so obviously, the previous line is fine. Yeah, this is fine. So in this example, it looks very intuitive, but I'm just curious, how many examples that you kind of check to kind of see if this kind of intuition is consistent over time?
Yeah, we didn't do anything too systematic. We just looked at a couple of ones which are intuitive there. I mean, this is just, we thought about whether you could maybe run some more sophisticated analysis of trying to evaluate change points and their usefulness. For us, it was just, can we understand how the model is actually getting away with this change point? So we looked at one where we have clear change points we know about and see what does the model, does it do something correct there? And yes, it does these spikes. And what we mainly also wanted to figure out, that's why we have these three colors, could be that the model always pays attention to 7 days ago, no matter where it is. Can be something like this. I always pay attention to a month ago, a specific feature, which is always a given time in the past, given how the data is structured. So we actually wanted to see if I now roll forward in time, can I keep on attending to this moment? That was quite important to us. Otherwise, it wouldn't be like a genuine change point if it moves as I move along. And this is what we try to see here, where we move along and it kind of keeps on attending to this. Again, this is not like exact. It's just like it seems to be learning something and is able to use that. But there's a lot of other spikes here. This is where it is all data driven. Similarly, the change point detection, there's a lot of kind of false information. When I plot this change point, when I do the plotting, I also would have taken a threshold and then drawn a line where the threshold is, whereas the model actually doesn't have those thresholds. The model just sees the whole thing and it changes as it goes along. So it's slightly different there. So I mean, but we can at least understand intuitively how it does it. And again, if we could do this with certainty, that would be the holy grail switching between momentum and reversion. It's just that within the noise of the data, that we can do this to some reasonable extent, which improves the performance. This is mainly what we were after. Yeah.
I see. Thank you.
Pass it down.
Hi, thank you for the talk. My original question was actually more around, false change points or outliers, which could rather be there. But having heard your answer to that, which completely made sense, I was just thinking, what would your opinion be for a use case of like, this is more of a where, we are analyzing more longer periods, essentially using data annually or yesterday's data for to predicting something for today. Now, if we talk about more about intraday market making, let's say, do you think combining this with, let's say, having two models, or I mean an ensemble of models rather, with different attention spans, let's say a smaller attention span and a wider attention span, or having something which can work on predicting the pattern in the change point itself, could be useful for an intraday market making experimentation?
Well, I think there are two different questions. So first of all, can you use something like this intraday? And then another question is, can you maybe use different look backs?
Yeah, I just thought that probably an ensemble on this.
Yeah, any of that
attention spans,
any of that, there's no reason why you couldn't do that on the daily data as well. So that's why I think of two separate questions. One, does it make sense to look at different look backs and ensembling, no matter which frequency? And can you take some of those ideas to faster frequencies? That's, I think, the two questions here. Yes, you can make some sense. For example, I mean, one thing I mentioned that when we put change point detection in the transformer, we can actually add a whole stack of different lookbacks, and the model can actually better make sense of the various lookbacks. So it's not like ensemble model per se, but it has now different lookback change point inputs, and is then trained on this. The LSTM couldn't make any sense out of multiple. It could only deal with one, basically. Otherwise, you would be overfitting. So it's kind of interesting that we can do that. So it's not ensembling, but it's something like this. You could also try to train different models and ensemble them, but I would say that the ML model should be more powerful than just taking the average of different ones. So I think taking the mean at the end should not be as good as if you actually take the various look back inputs and then have them in the model there. We didn't test that specifically, but to my point of view, that what we did is different look back inputs, and that does perform slightly better, but not by a large amount. And the other question is, can you use that stuff intraday? Yes, in principle you can. I don't write any papers about that, but it's something obviously you would expect if you have more data at, say, intraday levels, that you can train those models much better. I mean, our biggest problem here is with this type of data, we have 30 years, but it's still not a lot of data, and those models are quite complex. So it's difficult to have this complexity while not overfitting, and there's a lot of regularization going into many places. Your life will become a little bit easier if you allow yourself to have faster data, or also more structure, limit order book or something that's more structure, or also including the cross-section. These models here, the loss function is averaged over the portfolio, but the model itself is just a univariate model. It's the same for all instruments. And we know it's much more difficult to fit univariate models on daily data than anything cross-sectional, because again, in the cross-section, we have more structure. So you can apply those things as well to the cross-section, or combine cross-section and time series, where then you can leverage a little bit. You know, if the whole sector is trending, it's something else if just one guy is trending, and you can make sense of this stuff as well. So we have some upcoming work as well. So we use different encoders. For example, you could, I don't have a picture, you can use here encoders which look at the whole cross-section and have some convolutional filter, which can then also learn some kind of sector dependencies. And then the model becomes more powerful. So yes, you can do that various things. You can do faster, staying univariate, or you can also go to the cross-section, which also gives you more structure the model can learn on, basically.
Okay. Just on thought, because you said this will be useful directly applicable in intraday market making as well. So, because the approach that you mentioned is that it works on predicting, basically detecting rather one change point in a span, right? So, wouldn't that be required to be modified in terms, because in intraday you would see a lot of variations, right? And not probably just one change point could not really be the right signal to be going ahead.
Well, I wasn't really speaking about the change, but I was mainly speaking about the transformer model itself. But then again, here you also have multiple change points in different. The question is just the model pays attention to one, but you can have different lookbacks there as well. The question is what you are looking for basically, and then intraday things work a little bit.
Got it. I got the idea.
Different, but in principle, these type of transformer architectures, you can apply them also to faster returns, and you can then use them to kind of do different things. So we have this paper, which we actually just put on the archive, which gets rid of all this handcrafted inputs, which just takes a cross-section of daily returns, and then you can kind of tell it by the encoder whether you wanted to focus more on the time series or whether you want to focus more on the cross-section or maybe both. And you can specify basically this, and then you can let it learn. And it also has things like turnover regularization, correlation. Do you want to be not correlated with long only? It's all in the loss function. We have this, it's called the deep inception model. You can check it on the archive. It will be to that tomorrow, basically. But yeah.
Ladies and gentlemen, I think we should probably call a halt here. We can continue the discussion over drinks at the far end of the corridor. Just remains to thank Stefan one more time, and please join us for drinks afterwards. Thank you.
Thank you.